Hi class, this video is going to run through exercise 11.5. So if you're working through at home, you'll find this in your textbook on page 231 and your workbook on page 203. This is a question that's going to ask us to create an income statement for our business, Costello Auto Shop. And we've been given a trial balance here that has a number of accounts or general ledgers balances at the end of 30 June 2023. We're going to be asked to make an income statement, which means we're going to report profit, which means the elements we're trying to find are going to be all our revenues and our expenses, because it is revenue minus expenses that equals our profit. We're going to do this relatively quickly. If there are any that we identify as revenue or expenses that you're unsure of, I would recommend that you put them into a list so you can't to build a real great list of all the revenue expenses that you might see. Let's go from column to column, from top to bottom, and identify all of these elements. Advertising is an expense, wrappings expense, accounts receivable asset, equipment asset, legal fees expense, GST clearing, remember we assume is a liability. An inventory loss is one to stop and pause. Inventory loss is an expense. So we've done a count clearly and realized we've got $2,000 less inventory than we thought in our inventory card. Cash sales is revenue. Cost of sales is an expense. Buying expenses an expense, and accounting fees an expense. So there might be a bit of a hint. If you see the words expenses or fees, you know they're going to be expenses. And if you see the word sales, apart from cost of sales, it's going to be likely revenue. So if we continue on, sales return, a stationery expense is an expense. Sales return is one to highlight. It is in a sense an expense, but we're going to consider it negative revenue, and I'll come to that one later. Cartage inward is an expense. Accounts payable a liability. Telephone an expense. Interest expense an expense. Inventory an asset. Bank overdraft a liability. We have negative cash in our bank account. And credit sales is revenue. We're then going to pick up the information that is revenue and expenses and put it into the appropriate part of the income statement so that we can record gross profit, adjusted gross profit, and net profit. And just a word of warning, your solutions in your textbook have one error, and we'll highlight that just as we go through. But the first thing we're going to do is write our revenues, and we're going to write them at the top because we start with our revenues. And our first one that we're going to write is cash sales. Now I would normally put the first one here, but there's a bit of a mistake in the template. We need those three rows. Cash sales being $35,000 and our credit sales being $32,000. Now we would normally add these up, but we have something that we need to subtract, which is less sales returns. Remember, this is a return of a sale because there's been an issue with it. And this is important to record as a negative so we know if there's an error, a significant issue in our business. So if we go 35,000 plus 32,000, that is $67,000 worth of revenue, minus the 2,000, mean our total on our right column is 65. We're then going to less our cost of goods sold, and that is your cost of sales. Always cost of sales goes here. And our cost of sales here are $28,500. And then we're going to go look through all of our expenses and try and come up with anything that gets us into the condition and location ready for sale. So cost of goods sold, and COGS is an abbreviation. That is anything that is a cost to get into condition or location ready for sale. So do we have to modify it? Do we have to pay some money in the buying of it? Or do we have to pay some money to get our inventory into our location? There are two that we need to add. Cartage inwards is a delivery fee that we've incurred to get this inventory into the position ready for sale, and that is $500. And also we have buying expenses, a common one that is to get into the condition ready for sale, because we've had some expenses to do the buying expenses being $300. This equals $29,300, which means that we have, when we subtract this, we have and apologies, I made a mistake. Sales return should be $1,000, so it should be $66,000. That's your mistake in the solutions. So we should have a gross profit of $36,000. $36,700. We're then going to look, has there been an inventory gain or an inventory loss? We have an inventory loss here, so we're going to less inventory loss to get our adjusted gross profit. And our inventory loss here was $2,000. And there's only one of them, so you don't have to put in the left-hand column, which means our adjusted gross profit is $34,700. We're then going to go through and less all of our final expenses, of which there are 7 of them. So let's write them all out, and then we'll calculate our net profit and be done. Advertising is $1,600. Wrappings, $1,080. Legal fees, being $270. Accounting fees, being $200. Our stationery expenses are $140. And our telephone is $170, and our interest is $400. So if we add all those up, we get to $3,860, and of course you use your calculator for that. And that gives us our net profit of $30,840. We will then look at this, and that's your answer. We can tick off A. You're not asked to do any analysis, but let's do some analysis. We've got roughly $65,000 of sales, less $1,000 of sales returns, so $66,000 of revenue, and this has resulted in a profit after all of our expenses of $30,840. That seems like a pretty good business. And you could then make some recommendations to the business owner. Are there some things to improve? Could we be using this profit to buy some assets? Who knows? That's your job as an accountant. What are 3 ways that we could evaluate our net profit? We have lots of ways to evaluate. We could look at trends. So what are the past trends? Is our profit going up or down? We could look at our budget. So what were our expected results? If we thought that we were going to get $20,000 profit, we've had a good year. But if we thought we were going to have $80,000 profit, we've had a bad year. So 1, 2, and our third one that we could look at is most certainly industry averages. What is the typical profit of a business in your industry of a similar size? And guys, that is how you make an income statement from this particular type of trial balance, and some ways that you might look to evaluate it. Well done, and keep practicing your accounting.